Good afternoon. My paper will elucidate the elements of auditing financial statements for a company. It will cover what an audit is, how an audit is carried out, forms of opinion, and closure of an audit. What is auditing? Auditing is an independent examination of financial information to express an opinion on its fairness. It involves verifying the accuracy of financial records, identifying potential risks and opportunities, and ensuring compliance with regulation. Accountants and auditors play a crucial role in the process, ensuring that financial information is reliable and transparent. Purpose of auditing. Auditing helps build trust between investors, companies, and other stakeholders. It provides assurance that financial information is accurate and reliable. Understanding the audit process. In comprehending the auditing process, one needs to know the key steps of conducting an audit. The key steps for a successful audit of financial statements for a limited company includes: Step 1, the audit objective. It is important to clearly state the purpose of the audit, which is to express an opinion on the fairness of the financial statements in all material respects. The audit objective may include checking the company will continue as a going concern, as well as complies with the laws and regulations. The audits may also be conducted for statutory purposes or reporting to shareholders annually at an AGM or annual general meeting. Step 2, the scope of the audit. The auditor must define the specific financial statements being audited. For example, statement of financial position, statement of comprehensive income, cash flow statement, statement of changes of equity, as well as the financial period being covered. The scope can be agreed with the clients in the terms of engagement as well as terms of reference. Step 3, audit standards. It is imperative to mention the applicable auditing standards being followed. For example, the audit can be carried out using generally accepted accounting principles in what is known as GAAP, as well as international auditing standards or IAS internationally, as well as ensuring that financial statements comply with International Financial Reporting Standards, IFRS. Step 4, management responsibility. One must acknowledge that management is responsible for preparing the financial statements and maintaining internal controls. Management also makes representations with regards to management estimates, as well as complying with money laundering procedures. Step 5. Once you're complete with the management responsibility, it is important to design the audit procedures, which will cover the following. The planning stage. This mainly focuses on understanding the entity, the industry, and internal controls, as well as the KYC or know your client procedures that are done. Point 2. It is important to conduct a risk assessment. You need to check if the risk for the purpose of audit is high or low, depending on the effectiveness of the controls. Thirdly, you need to design the audit plan and test methodology. Based on the risk assessment conducted and planning of the methodology, you need to ensure that the audit evidence is obtained to cover the risk exposure of the company. Point 2. In conducting your audit, it is also important to carry out or conduct internal control assessments, including conduct an evaluation of controls, covering the design, effectiveness of internal controls. Furthermore, you need to test the controls for effectiveness. This process involves checking if the controls are working efficiently and effectively. Testing can be done via sampling of transactions and checking compliance with company financial policies and procedures. Thirdly, in conducting your work, you need to conduct what is termed as substantive testing, which includes but not limited to verification of transactions, This includes checking bank balances, creditors, receivables, and ensuring that they are accurate. Verification can also be done on a sample basis based on the risk factor, which will be demonstrated in the other part of this presentation. Review of balances. This is done by ensuring that reconciliations are conducted regularly. Analytical procedures. These may be done to ensure that there is an explanation in significant changes in account balances compared to previous years. Other procedures, such as alternative procedures and third-party confirmations, are done to ensure accuracy as well as avoid misrepresentation of balances. Review of subsequent events. At the end of this audit demonstrated above, it is important to review activities post-year end, which may impact current year you are auditing, such as a loss of a company's only customers, which may impact the going concern. Compliance with laws and regulations. Compliance with laws and regulation is now an important part of an audit, and auditors are required to make an opinion on this. This includes industry laws and regulations, Companies Act, and other significant laws and regulations. Step 6. Once the above process is done with, the auditor may issue what is termed as an audit opinion, which can be either unqualified opinion. This is issued when you have not found anything significant during the audit process to report on. It may be termed as a clean audit. Secondly, you may also issue what is termed as qualified opinion. This is given when an auditor has found an area which may impact the going concern of a company and may need to bring this out in the opinion. Other forms of opinions include adverse opinion, disclaimer of an opinion, which may be issued depending on your audit findings and limitations. Step 7, conclusion. Once the auditor has concluded with the above process, he may need to render what is termed as the auditor's signature. This includes the date of the audit report, the date of the audit report. This is signed by the audit practitioner, normally an audit partner licensed by professional body such as ACCA, Zika in Zambia, to conduct external audit processes. The auditor's name and firm must be that of the audit practitioner with authorized to issue audit opinion and must be stated on the financial report. Other key considerations of the audit include independence. This is to ensure that the auditors are independent and are objective. Professional skepticism. The auditor is required to use his professional experience and intuition when conducting his work. Documentation. The auditor is required to thoroughly document all procedures and findings. Audit evidence must be collected and working papers retained by the auditor to support his opinion. Communication. It is important that the auditor maintains communication with the audit client. This is also done via management letters, finding letters, and other meetings a client may have approved in terms of forms of communication. This, ladies and gentlemen, is the form of audit process I submit. Thank you so much.
Good afternoon, class. My presentation today is going to cover the aspect of the abridged aspect of audit sampling. Audit sampling is guided by a standard code ISO 530, which is international standards in auditing. And I'm going to also cover the aspects of substantive testing with the focus on operating expenses. Now, when you're looking at sampling method, the factors that determine the sampling method and the sample size is normally what we termed as a risk assessment. Risk assessment is normally carried out at the planning stage. This is where you determine how effectively the controls in an organization are working. Simply put, controls are a mousetrap. If your mousetrap is able to catch all the mice, it means your controls are actually working. The trap is able to catch the mice. If the mousetrap is only able to catch some mice, then we can actually say that the controls are working to some extent, but not to the required standard. This is what we call a medium kind of risk. And using the sampling techniques, this factor is number 2. Then the third aspect of risk is what we call high risk, meaning the controls that are in an organization are not efficient and effective. They are not doing what they were intended to be doing. This means that your mousetrap is not catching any mice at all. So depending on this, it has got an impact on the number of items or documents that you're going to look at as evidence in what we term as the sample size. The sample size determines the number of documents that you're going to actually look at in terms of an accounting balance. To start with, you need to be given a trial balance by your clients. In this example, I'm going to use an abridged trial balance, meaning not a very long one, a short one. The trial balance will show you the operating expenses, among other things. But our focus really is that as an auditor, I'm actually looking at expenses. So I'm going to sample my expenses, which are these highlighted, which I need to move in my substantive testing formula. The testing formula actually uses what we call monetary unit, which I've actually now put here to demonstrate. Monetary units because it's money. Some of the financial information can either be narrative or analytical, but this aspect is focusing on monetary unit, which is actually money. So the total expenses in sampling is what we call your population. In this aspect, we're looking at the 831,000. The population is the key or the amount that you're going to sample. Let me demonstrate by putting the same in the formula. So you need to move your, if you can follow, the population. I'm bringing it from here to here. Now, pay particular attention to what is happening here. When we use this risk factor of 3, which is low risk, like I was explaining earlier, you'll see that the sample size is actually higher, 11. When you use the medium aspect of the sample, you'll see that your sample size is actually 160. When you use a risk factor which is high, meaning there are no controls in an organization, your risk factor triples. It goes actually to 475. Meaning that in an organization where there are no controls, you actually have to do a lot of work. In arriving at all these samples, you need to consider what is known as materiality. Materiality is simply the amount or the appetite that a company will take in terms of expenses that it may not be material for you to actually pick it or sample. So the materiality in this aspect, I've not covered that aspect of the planning. We may assume it's just 2,500. How the materiality comes into play, you'll see that it actually divides into the revised sample once you take into consideration the risk factor. So the materiality is an acceptable level of error that the company or the auditor is willing to accept. It's got an influence on the sample size. So the key takeaway from this sampling is that where you've tested the controls and they're working efficiently, your sample size is low because the risk is very low, so you have to pick very few items. Similarly, medium, you have to pick medium items, and high, you have to pick high. So higher risk, the higher the sample that you actually need to carry on. Let me demonstrate what is key. Again, when you pick up this sampling, it has to reconcile to the income statement and guide in which ledger accounts you're going to pick the samples. I've made a little bit of life easy already. Here it's already demonstrated. So you'll see if we take the risk to be high, this is going to be the breakdown from each account. So meaning I've divided the factored amount divided by the risk factor, divided by the materiality to give me the sample size. So in here I'll test 104, etc., etc. So this 475 actually reconciles to this 475 here. It means everything is perfect. Let's go to medium. Which is 2. You see the sample size is 166, which reconciles. Similarly, if you use a factor of say 3, that is your sample size, which perfectly reconciles. Ladies and gentlemen, this is how you carry out what we call an audit sampling using substantive testing. I hope it is clear. Thank you so much for